Hello everyone and welcome back to Shiva Finance Academy. In this video, we are going to understand one of the most confusing but most important topics in accounting, debit and credit. This topic is the foundation of accounting. If the debit and credit are clear, then journal entries, ledger postings, trial balance and even final accounts become very easy. This video is specifically designed for class 11, class 12, BCom and CA foundation students. Please watch this video till the end for complete clarity. Why debit and credit confuse students? Most students find debit and credit confusing because they try to memorize the rules without understanding the meaning behind them. Many students believe that debit always means expense and credit always means income. This assumption is incorrect and creates long-term confusion. In this lesson, we will follow a logical approach. First, understand the meaning, then identify the type of account, apply the golden rule, and finally see the example. Meaning of debit. Debit means receiving the value or benefit in the business. Whenever something comes into the business or increases the benefit of the business, it is recorded as debit. Debit represents increase in assets and expenses. It does not automatically mean loss or expense in all cases. In accounting books, debit is always written on the left side of the account. Meaning of credit. Credit means giving value or reduction of benefit from the business. Whenever something goes out of the business, it is recorded as a credit. Credit represents increase in liabilities and incomes. It does not automatically mean profit. In accounting books, credit is always written on the right hand side of the account. Types of accounts. Before applying debit and credit, it is compulsory to identify the type of account involved in the transaction. There are three types of account: personal account, real account and nominal account. Each type of account has its own golden rule, which must be applied correctly. Let's look at them one by one. Personal account. Personal accounts are the accounts related to persons. Person does not mean only human being. It also includes natural persons like Ram or Sham, artificial persons like bank or company, and representative person like outstanding salary. Whenever it involves a person, it is treated as a personal account. The rule of the personal account is debit the receiver, credit the giver. First, identify who is receiving the benefit and who is giving the benefit. The receiver is debited and credit is the giver. Let's look at an example. Paid salary to Ram rupees 10,000. Ram receives salary, so Ram is the receiver and Ram account is debited. Cash goes out of the business, so cash account is credited. Journal entry will be Ram account debit to cash account. Real account. These are the accounts related to the assets of the business. Assets include cash, furniture, machinery, building and goodwill. Whenever an asset is involved in a transaction, it is treated as a real account. The real account golden rule is debit what comes in and credit what goes out. If an asset enters the business, it is debited, and if an asset leaves the business, it is credited. The example for real account: purchased furniture for rupees 5,000. Furniture comes into the business, so furniture account is debited. Cash goes out of the business, so cash account is credited. Journal entry will be furniture account debit to cash account. Nominal account. These are the accounts related to expense and incomes. Example: rent, salary, electricity, commission and interest. Nominal account help in calculating the profit or loss of the business. The golden rule of nominal account is debit all expenses and losses and credit all gains and incomes. Whenever an expense occurs, it is debited. Whenever an income is earned, it is credited. The example of nominal account: paid rent rupees 8,000. Rent is an expense, so rent account is debited. Cash goes out of the business, so cash account is credited. Journal entry will be rent account debit to cash account. Let's look at one more example. Received commission of rupees 3,000. In this case, commission is an income, so we will credit commission. And cash is coming in, so that it will be debited. So cash account debit to commission account. To summarize, always remember what comes into the business is debited and what goes out of the business is credited. First, identify the type of account and then apply the golden rule. Following this logic will remove all your confusion related to debit and credit. If this lesson helped you understand debit and credit clearly, please like the video, subscribe to the channel for more accounting concepts explained in a simple way. Comment below if you have any doubts or question. Thank you.